The November Financial Security Index results are in, and confidence has fallen again. So we discussed the reasons why. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. We've just released the November 2017 results from our Household Financial Security Index. The index uses data from our household surveys to assess households' levels of financial comfort. By way of background, these results are derived from our household surveys, averaged across Australia. We have 52,000 households in our sample at any one time, and we include detailed questions covering aspects of a household's financial footprint. The index measures how households are feeling about their financial health. To calculate the index, we ask questions which cover a number of different dimensions. We start by asking households how confident they are feeling about their job security, whether their real income has risen or fallen in the past year, their view on their costs of living over the same period, whether they have increased their loans and other outstanding debts, including credit cards, and whether they are saving more than last year. Finally, we ask about their overall change in net worth over the past 12 months, and by net worth we mean net assets less outstanding debts. The index fell to 96.1 in November, which is below the 100% neutral metric, down from 96.9 in October. This is the sixth month in succession the index has been below the neutral point. Owner-occupied households are the most positive, scoring 102, whilst those with investment property are down to 94.3 as they react to higher mortgage repayments, which include rate rises and switching from interest-only mortgages, whilst rental yields fall and capital growth is stalling, especially in Sydney. Households who are not holding property, our property inactive segment, will be renting or living with friends or family, and they scored 81.2. So those with property are still more positive overall. Looking across the states, households in New South Wales and Victoria are just above the neutral setting, but they continue to slip lower. Households in Queensland are below the 100, but up a little, as are those in South Australia and Western Australia. Western Australian households are the least positive, but improved somewhat this time. Across the age ranges, younger households are the least positive, and all age ranges fell, other than those over 60 years, which saw a small rise. Looking at the FCI scorecard, job security is on the improve, reflecting rising employment participation and the lower unemployment rate. Around 20% of households feel less secure, especially those with multiple part-time jobs. Savings are being depleted to fill the gap between income and expenditure, as we see in the falling savings ratios. As a result, nearly 40% of households are less comfortable with the amount they are saving, and this is being reinforced by the lower returns on deposit accounts as banks seek to protect margins. More households are uncomfortable with the amount of debt they hold, with 40% of households concerned. The pressure of higher interest rates on loans, tighter lending conditions and low income growth all adds to the discomfort. More households reported their real incomes had fallen in the past year, with 50% seeing a fall while 40% saw no change. Only those on very high incomes reported real income growth. More households reported a rise in their cost of living, and this month this included higher school fees and childcare costs, energy bills and fuel costs. The average CPI of around 2% appears to understate the real-life experience of many households in our surveys. Finally, household net worth improved for more than 6% of households, but there is a rise in those seeing no growth, mainly as home prices ease back. Those with share market investments have done quite well in recent months. Looking ahead, we expect the overall index to trend lower as incomes remain constrained and the cost of living grow. The property market has a big impact on households' levels of confidence, and the leading indicators are flagging lower outcomes ahead. However, home prices would need to fall significantly to allow many of those currently unable to afford to buy into the market. We will update the results again next month. If you found this useful, do leave a comment and subscribe to receive future updates. And many thanks for taking the time to watch